Now we're going to shift gears. We're going to talk about structuring EB5 capital for hotel and restaurant franchises. Joining us today for this presentation is Mr. Samuel Newbold. He's chair of the immigration law practice at CSG Law, officing in both New York and New Jersey. Sam represents companies all over the country. They have a national practice, especially multinational organizations, providing counsel on employment-based immigration as well as corporate compliance practices. But most importantly for this presentation, he heads up the firm's EB5 practice, but he has also managed many of these EB5 funding processes, and so he's well versed to share his insight with us. Let's welcome Sam.
Thank you.
Marisa Rauchway, team leader of franchise law for CSG. Marisa serves as the strategic legal advisor and partner in local, regional, and national franchise, the community across a wide range of industries, including the hospitality industry. You can see why they have joined together. It's a great synergy. Thank you both. We look forward to your remarks.
Thank you. Happy to be here. I would just like to poll the audience here. Who here has any idea what EB5 actually is? So a few people, right? But Marisa has always presented at hospitality and franchise conferences before, and EB5 has always been a question or a topic that's come up. And so what I'd like to kind of do before I get into explaining very briefly what EB5 actually is to give you an idea of how prolific it has become. Right? So EB5 Capital is a green card program. You've probably heard about it in the news in positive and negative lights, but essentially it's a way for companies to raise capital from abroad for their projects, and in exchange for that, foreign investors have the opportunity to apply for a green card. Now, this program is not new. This program has been around since 1990. And over $30 billion of EB5 capital has been raised and utilized throughout the United States, hundreds of millions of which are right here in Houston. And my clients are all over the United States, and they've raised it for all different types of projects, including hotels, restaurants, event centers, casinos, you name it, everything across hospitality. The reason why it's important is because as lawyers, it is becoming much more common to see deals, especially in the M&A space, restructuring, that have EB5 capital in them, and people are like, they start opening up and looking at this, and they look at the capital stack and what the capital structure are of deals, and they're like, what is this? I've never really seen this before, but there's millions of dollars of debt or equity in this deal, and I don't even know what this is. I'll give you a good example. I was representing a client recently who was buying a chain of healthcare facilities across West Virginia, Ohio, Pennsylvania, and all of them had EB5 capital in them. And the reason why it's important to point that out is because it's going to become more common as more and more of this capital comes into the United States to understand at least what the broad framework of it is, so that you can identify it as a lawyer and say, okay, we need to kind of figure out what this is, what are the rules and restrictions around this program, and how can I advise my client appropriately, through this specific type of capital. All right, so I'm going to have a few little asterisks here, because I need to, because we're lawyers, right? So this is going to be a very limited scope of EB5 to really focus on how you structure those deals in terms of a corporate framework. EB5 is a very regulated, highly regulated space. Not only is it regulated within the immigration space, but it's highly regulated within the securities space. When you are raising EB5 capital, the vast majority of EB5 capital is raised by forming special purpose entities, much like you would do in a traditional private equity type of offering. You're creating a special purpose entity, you're pooling together capital from a lot of different investors, and that money is being deployed into a project for a specific purpose. And so those entities are issuers, and they're issuers of securities. And so when we're talking about EB5, floating around in the ether here at the back of your head, keep in mind that everything is regulated by securities, and the activities and sales of those units in the EB5 industry is regulated by securities. And so whenever you're thinking about what is EB5 capital and how do I go to market with that, you're counseling your clients on, first and foremost, guys, this is securities, so you need a good securities lawyer. You need an industry expert who understands EB5 and how it works. All right, so as I said before, EB5 has been around since 1990, but it wasn't until last year, March of 2022, that our government passed the EB5 Reform and Integrity Act, which essentially modernized a lot of the old rules with EB5 and created some carve-outs, new rules and provisions that are now the standard today when you're thinking about going to market for EB5. And so broadly, EB5 is a green card program that allows foreign investors to apply for a green card or permanent residency status if they can demonstrate that their investment into a company will create at least 10 full-time jobs. Now, from the US side of things, the benefit and the incentive here is that I get tax-free dollars, all right, that I can use to benefit the economy and create real jobs. And so there's a big balance here between this is the incentive we're going to give foreign nationals for this type of money, and this is the benefit that we're going to get as a country from taking this money in. Now, by and large, this has been a successful program with some black eyes, and the black eyes have always come around fraud, misappropriation of funds, things that you see not just in EB5, but in a lot of private equity and securities types of raises over the years. So those same trends do permeate EB5 the same way that they do in regular private equity. Now, the vast majority of hotels, restaurant franchises, casinos, events, stadiums, when you're thinking about hospitality and events, those types of deals are big deals, okay? But it doesn't always have to be a big deal. We've had a number of clients over the years where it's just one owner-operator of a franchise. Person wants to open up a Dunkin' Donuts. Person wants to open up a Burger King, right? Wants to do a fast casual chain of some kind. It doesn't have to be, I'm going out and building, a $400 million Marriott. Or, Hudson Yards in New York City, where I'm from, which was $1 billion of EB5 money, which was the largest real estate development project in the history of the country. So it can be that big, or it can be very small. And your clients can be anywhere in between. So, is there a way that I can walk and point to this? Because it's a little bit tough to see on the projector. I'm going to have to point to stuff. Is there a pointer on this? There is? This dot?
Yep. There it is.
Ah, okay. All right. So the EB5 program has two primary types of sub-programs. One is called the Regional Center Program, and one is called the Direct Program. The Direct Program now, under the new statute, is really just for one investor who's largely going to be an owner-operator. So that investor who might just want to open up a restaurant, think of it as a company that's going to be an operating company that has a 10 headcount criteria. So that person has to create 10 actual jobs, go around the room and count your employees, and that's your requirement. Under the Regional Center Program, companies can apply for designation from USCIS, which is the regulatory body that adjudicates immigration cases, to be a regional center, which is a company that can pool together a whole bunch of EB5 capital and create a whole lot of additional jobs, but not headcount jobs. These are jobs using an economic model, similar to how government programs count jobs, measuring a ripple effect across the economy, and not just a headcount job. So for example, if you're going to build a $400 million hotel, it's going to cost $400 million using hard construction costs, soft construction costs, architecture and engineering, FF&E, and then it's going to generate, $80 million in revenue by year 2 or something like that. You can measure that. There are formulas, economic formulas to measure that, and you can actually calculate how many jobs that's going to create for the U.S. economy based on different inputs and outputs. That's primarily how jobs are counted in EB5, all right? And that's under what's called the Regional Center Program. And it allows you to pool together EB5 capital in much larger volumes because you can generate more jobs, keeping in mind that each investor has to prove 10 jobs per investor, and you just do the math from there. All right, so most EB5 deals are structured this way. You set up a special purpose entity like I talked about before. This special purpose entity exists for one purpose. The EB5 investors are going to invest each $800,000, which is the statutory minimum. All right, they're going to get equity in this entity, and then this entity is going to be managed by either a general partner or a manager. It could be an LLC or an LP. That's typically how they're structured. This entity can loan or invest that same capital down here to a project sponsor company or a holdco of some kind. And that debt or equity is going to contribute to the capital stack of this project, which may involve construction financing from a lender and a bank. There could be some additional private equity or some additional third-party financing over here. Obviously, the developer's own equity is going to come in here. And usually that entity is going to have a propco and an opco, a property company that owns the land, that has a lien with the senior lender, and an operations company, if we're talking about a hotel, for example. All right, that's a very sort of vanilla structure for, a development deal. And EB5 is very flexible and it works within that same framework. In some other deals that you'll see, the fund entity right here that has the EB5 money, it'll go to an affiliate holdco. And I say affiliate, mean that these entities are all pretty much related to each other. And then this will be a loan, and then this money will drop down and be equity into the developer's project here, because financing rules or banks may want some protections, or they may not like the LTV in a particular deal, and so that money is going to be used as preferred equity typically instead of additional debt in the deal. So you can get creative in terms of how you structure an EB5 deal in that way. And so for the lawyers in the room that have, a corporate background or real estate background, this should look pretty vanilla to you. And EB5 is very versatile in this way. Do you want to do questions as we go?
Whatever you think. Does anyone have any questions on anything
I like questions
Sam has
as
said?
we go. Interactive audiences are good. It typically will. But
Can
it
you
doesn't
repeat the
have to.
question, Samuel, just real quick? Repeat the question.
You were saying, does it have to have common parentage? The opco. It doesn't have to. It usually does, but it doesn't have to. The most important thing with EB5 is that wherever the money is going, so remember, the money is starting here with the individual investors. It's being pooled here, right? And then it's ultimately going to go down to this entity here, or these group of entities that are most responsible for creating the jobs, right? It's all about jobs when it comes to EB5, all right? And so if the nexus to the job creation and the EB5 money is clear, then the investors are going to get all the creation of jobs here. Now, one question we usually get with EB5 is it just the EB5 money that has to create the jobs, or is it all of the money? Because remember, we're just talking about the EB5 money coming in to fill a part of the total capital stack in that project. The whole budget for this project might be $400 million. EB5 might be $100 million of it. Right, where's the other $300 million coming from? Well, it's going to come from wherever else it comes from, the developer, from a senior lender, from other private equity. But the good news is that for the EB5 investor, the total job output of that whole budget, right, $400 million, goes to the credit and benefit of the EB5 investors. And the reason why that's important is because it allows you to increase the size of the fund, because you can capture more job creation. All right? So this is a relatively straightforward vanilla kind of deal. And this is usually how you will see EB5 capital coming in and to structure these kinds of projects. This can be a hotel. It can be an office building. It could be a hospital, a school, a stadium, And in fact, it has been all of those things over the years across the United States. You name it, an EB5 is probably in it somewhere. And I work with our M&A team all the time, and they're like, Sam, we just got approached, and we're representing buyer or seller in some deal, and there's like $10 million of EB5 in this deal. We had no idea. And so they bring me in, and they're like, okay, so what's the structure of this? How does it work? Where is the money in relation to the timing to the investors at this point? Were the jobs created? Have they not been created yet? And so this is a very specific area of law that is becoming more and more common on the structuring M&A side of transactions. Here's an interesting thing that has happened with EB5, and one of the reasons why EB5 has become popular is because it's quiet money for the most part. EB5 investors are motivated by two primary things, and the first and foremost thing is they want the immigration benefit out of it. A secondary concern is making sure I at least get my principal back if I can, and maybe a modest return. But the first benefit is what's driving them the most. And so for the most part, EB5 investment money is pretty quiet, and it's quiet for around 5 to 7 years. There's not going to be a demand or a very vocal demand for any kind of repayment of that capital prior to when your asset is going to be stabilized anyway. Yeah, go ahead. It's going to be tied to where your project is located. It's coming from all over the world. It's coming from all over the world. The primary, the largest, I would say, percentage of countries participating in EB5 are China, Vietnam, India, South Korea. Latin America is actually really coming up. South Africa is on the rise. It's actually becoming more dispersed than it used to be. It used to be pretty much all China, but not so much anymore. But yeah, it's coming in from all over the place. But one of the drawbacks of EB5 money is that it's slow. Okay, so if you are going to market in a normal private equity raise, you might be going to your go-to partners or your go-to investment firms that you work with to try and raise that capital, and they may have a capital call, right? And at some point in time, you're going to say, okay, this is when we need the money, and that capital call is going to happen, and the money comes in, right? And you fund your deal. EB5 doesn't work that way, right? It's coming in $800,000 at a time, and it's kind of coming in at drips and drabs. Sometimes it'll come in, 2 or 3 investors this week, and then it might be 2 or 3 investors this month. And so when you're trying to time your raising of the money with your development and trying to get your project, shovel ready, then vertical, that can be complicated because that's not necessarily what you need in terms of your funding timeline. So what has happened in the EB5 industry to help compensate for that is to use EB5 money as takeout money. All right, and I'll talk about the cost of the capital here momentarily, which is most of the questions that I get. If I get 10 questions, 8 of them are about how much does it cost to get the money, and the other 2 are about timing and job creation. Well, what will happen is you may have a mezzanine loan or a short-term construction financing loan at a certain interest rate that may not be that palatable to you, right? It might be at 8%, 10, 14, depending on whatever interest rate you get for whatever piece of financing that you need within your capital stack. And the EB5 money can be much cheaper than that. But because it's slow, you kind of have to bring it in to take out the more expensive money as it comes in. And we call that bridge financing in EB5, which is how bridge financing typically works outside of EB5. And that's been very popular. So what will happen is a developer will say, I'm going to build this hotel, over here on Walker, in Houston, and it's going to cost me $400 million. But I know where my money is coming from. I have my own money. I've got a good lender. They've already given me a commitment. I know how much that's going to be. I've got my CAPEX and my pro forma. I might bring in some other third-party money, but I'm like 8% short or 12% short. So you're going to go get short-term mezz of some kind, usually at a higher rate, and then you will go out and raise your EB5 money and take that out as it comes in. And you'll save on the interest rates on the back end, and you'll save several $1 million in financing costs doing that. And that's another typical way you'll see EB5 money come into deals, and it comes in later. Now, interestingly enough, the job creation that was created when that new money came in will be credited to the EB5 investors if you contemplated raising the EB5 money as takeout money from the beginning, right? So they'll create that nexus between the job creation and the spend and even the revenue that is generated from that project, even if the EB5 money comes in later to replace that money. They'll kind of like just swap it out, and they'll get the credit for that contribution in terms of job creation. So these are a little bit jumbled up in numbers, but I'll walk you through here. So how much does EB5 capital cost? Well, that's the main question I get from clients all the time is, what does EB5 money cost? Well, it's usually below market, but not always. A lot of clients, are super creditworthy and have great track records, and they can get really good competitive rates, on money. And sometimes EB5, depending on what's going on in the world and what their project is, may not just be that marketable for that particular project. But generally speaking, EB5 money is cheaper than going out and getting traditional financing. And I'll walk you through kind of how that works. So as we've said before, EB5 investors, they're going to invest at least $800,000 each into this SPE. The market rate of return on that is between 50 basis points and 2 points, right? So that's what the market is essentially demanding right now on average. There's some fluctuation in that, but by and large, that's what the return is going to be for the EB5 investors' investment here. The manager or general partner of that entity may have some additional costs, so they may keep a point or something like that for facilitating the fund and managing the fund. And this is where things get a little bit interesting down here. So if the EB5 money is pooled together in this SPE, it can then be deployed to the actual project developer as either debt or equity. And it can be all kinds of different debt or equity. There's all different ways that you can structure that on terms. You can do senior EB5 financing. That has happened before, where this is actually a senior loan, right? And it's collateralized by the assets of the company, just like a senior lender would have a lien on the propco. It can be subordinated. Usually it is. If you have a senior lender involved in a deal, they'll almost always require the EB5 money to be in some kind of second position to the senior lender. It can come in kind of one of these mezzanine arrangements, or this can be just equity. It can be common equity, though almost always never the case, but it could be. Usually it's a preferred, so functionally debt, but in a preferred equity arrangement here with a fixed return. And then you're like, okay, great. So, my left hand can loan myself money to my right hand at whatever terms I say, as long as I can generate this 50 basis points to 2 points to the investors, right? Not really, all right? This is where the missing piece in the industry, I think, always shows up, is that it costs money to get the money. Right? And how do you go out and raise $100 million in EB5 capital from, all of these different investors at $800,000 a pop? You need help. You need intermediaries. You need agents. You need people on the ground in different countries. You need broker dealers stateside doing things correctly with securities rules to go and get this money, and you have to pay them as well, right? So that is really just subject to whatever the arm's length negotiations are for that particular individual. But by and large, what we're seeing is that in a debt scenario, this is going to be an additional 4 to 7% all in. In an equity scenario, the returns are slightly higher, might be 5 to 8% all in for the cost of capital. And of this, let's say that this is 7%, this loan is 7%, that 50 basis points or 2 points is going to go back to the EB5 investors. There might be that 1% that's held to the affiliated manager general partner, and then the rest of that interest is going to go to the broker to go get the capital. So when we say it's usually below market but not always, it depends on what you're comparing it to. If you're comparing it to more expensive financing, it is much cheaper. If you're comparing it right now with interest rates, it's pretty good. But in low interest rate times, it would actually be more expensive than just going out and getting regular construction financing if you have a really good track record and success as a developer.
Sam, I'm going to jump in here if you don't mind.
Sure.
I apologize, but we're going to run out of time.
Okay.
And I think we'd love to hear from
Yes.
Marisa and her thoughts on the franchise side and how it all fits together.
We're-
But ladies and gentlemen, he's got 2 additional slides that are
It all
really helpful.
parlays into her grand finale.
Yeah, and he'll be around for the reception and he can chime in. So I just wanted to mention that. Thank you.
Sure. So just quickly before we parlay here, it's not a capital call like traditional capital. It's slow but quiet money. It usually takes between 6 to 18 months to raise the capital, right? So you need to have a runway to actually do the deal in order to have that kind of development runway and timing to bring that money in. So no really short deals at scale. Timing is difficult sometimes, particularly in larger deals, depending on if your project is fully financed or not. And usually it's going to be tied up for at least 5 years, in most deals. All right. And so I'm going to parlay that with franchising in EB5 that Marisa's going to talk about here, because EB5 is really popular, especially with franchises in restaurants, fast casual dining, small hotel deals, and she can talk about her experiences with that.
Yeah, absolutely.
Here's your
Grab this.
clicker.
Thanks, Sam. So like Sam said, I am a franchise lawyer, and I think he mentioned at the beginning of his presentation, in the last year, by far, every conference I've either spoken at or attended, the most common question is, do you know anything about EB5? What's with this EB5 program? For all the reasons that Sam mentioned. And, I'm sure there are a number of people in the room, involved in, either the restaurant or hotel, franchise space, but you can imagine why. Just taking a step back, the franchise model sometimes, not always, can be particularly conducive to everything that Sam just mentioned. I'm sure, as many of you know, franchising is a model. It's not a box you fit into. There's a lot of flexibility in it. So even though there's all sorts of red tape and regulation in my world, just as in Sam's world on the federal level and a labyrinth of state laws, I mean, at the end of the day, virtually, if not all franchisors are looking to use this model to expand their brand with somebody else's money, while of course keeping controls and providing a certain level of support to make sure that whatever industry you're in, that somebody who is in a fast casual location in Texas is going to get, if not the same, a similar experience as if they went somewhere else. So what I wanted to do is just focus on why the franchise model, particularly in the hospitality space, often, but again, not always, can be a particularly good business model for EB5 capital. And the first, as Sam mentioned, this job creation. Franchising, of course, unless you're dealing with a new franchise, I think the last number I read was there's 75,000 franchise concepts in the country. So I'm not talking about the new franchisers, but often when you're dealing with an established franchise, you have other units to look at to show, oh yes, there likely will be 10 jobs created. We're not talking about something that is new. So there is a little bit more, evidence that this job creation actually will happen. So that's one. Two, Just the idea. I mean, it's sort of common in the franchise world to say franchising is going into business, for yourself, but not by yourself. It's kind of corny at this point how often that line is used, but it's really valuable potentially for an EB5 investor, an EB5 investment, because it's not just the owner or owners who are, tasked with making sure that the business, whatever it is, succeeds. You often have a huge franchise system providing advertising and marketing and operational support to make it a potentially, again, not always, more a safer investment. So that's another thing. Also, if you're dealing with a global franchise brand, that also can be particularly attractive to somebody coming from another country who's looking to invest money. It's not something that they've never seen before. They may have a location in their backyard or near them. So there are some very unique qualities and characteristics to franchising. Again, I know I'm tight on time, so I'm just going to quickly go into why franchising may not always be the greatest. It may sound good, but it really depends on which franchise system we're talking about. And I think, Sam, you mentioned it earlier, that there's a timing issue. Depending on what franchise system you're dealing with, some franchisers don't want to deal with the timing issue. And in fact, this just came up for one of our clients, I think a couple weeks ago, where they wanted to invest in a franchise unit and use the EB5 funding, and they were going along, and then the franchisor stopped it because the franchisor didn't want to wait for the timing that needed to happen in order for this money to come into place. Also, franchise agreements in general, sometimes I would say they are often not designed for EB5 investors. So, I mean, it's a little bit of a myth in franchising that franchise agreements are never negotiable, but there either may be some negotiation that needs to happen to some of the provisions to take into account EB5 investors, or the franchisor, again, it just might not be the right franchise system. So bottom line, as Sam mentioned, EB5, super hot topic in franchising and franchise concepts. I get asked about it all the time, and super happy that I have Sam to call, as he mentioned, whenever an EB5 question comes up. So that's really it.
Yeah, with the hospitality industry being such a good job creator, like EB5 has always been kind of like a magnet to that, because you're like, oh, well, it creates a lot of jobs, and a lot of those jobs are maybe blue-collar jobs or whatever it might be, but doesn't matter what kinds of jobs, just a job is a job. And so it's always naturally attracted interest from the EB5 industry, and the franchise model, because you can replicate it over and over again, has also been very attractive within the EB5 space because it's somewhat predictable. The locations may change, the costs may change because of the location changes and stuff like that, but it's something that at least EB5 investors can sort of understand and see how that's going to play out, because there's a model ahead of it that they can say, oh, okay, well, I can expect this and that. Same thing with hotels, right? Boutique hotels have always been very popular. Big ones too, entire giant casinos have been built, in resorts with EB5 money, but also, boutique hotels have been very popular in the EB5 space on the franchise level, because they're also kind of like predictable in that realm. So we've done a lot of work there too.
We've got time for one more question, if anybody has it.
Yeah, go ahead.
You mentioned early on regional centers.
Yeah.
I've never really understood what is a regional center. Where does it fit in the diagram? Is it like the placement agent?
Yeah.
Or is it like the fund itself?
Yeah, so a regional center is just a private company, or it's not a government entity. It's a private company that submits an application to USCIS, disclosing and describing to USCIS how it's going to promote EB5 to create jobs and boost the economy in their specific region. It's called a regional center because they have a defined geography that they can do this in. You can't just do it anywhere. So I'm going to do this in, Houston and Dallas, or maybe the whole state of Texas, depending on what their idea is. But you're not going to find, these massive ones. And all it does really is it sits on top of that fund entity, right? And some regional centers create their own funds, go out and raise their own money, right? And do the whole deal sort of in-house. A lot of regional centers, I'd say over half of the regional centers, are in the business of being a regional center, meaning that all they do is they're in charge of compliance, regulatory oversight, and making sure that the projects are doing what they're supposed to be doing, and then they kind of just rent out their license to various projects, and they collect sort of a syndication fee and annual fees on a rolling basis to sponsor all these different projects. But the regional center is actually the entity that's responsible for making sure everyone's doing things correctly. So there's a lot of risk and exposure in that. If you're comfortable with that, you can make a lot of money, because if you have the connections with projects, the more projects you do, and there's actually a big business in it now. But it could be either way there with that, but that's the role of the regional center.
You mentioned that a significant portion, if not the largest, is Chinese. With all the regulatory issues that are suddenly arising on Chinese investment, do you see that that's going to change the availability of money from China
Yeah.
into EB-5 in the near future?
Yeah, that's a great question, and as an immigration lawyer, I'm seeing what's going on around the world all the time, oftentimes firsthand with clients and their takeaways. And China's an interesting market at the moment because there's certainly demand. And the issue you have in China right now is that you can't get money out of China. There's heavy regulations on money exchanging, direct transfers out of China. And so one of the biggest issues with China is actually how they get their money out to make these types of investments. It's not just to make EB-5 investments, how do they get their money out to pay for their kids' college tuition if they're going to school here, just bigger things like that. So I think with the tensions going up between Taiwan and the US and China, you're seeing an uptick in awareness politically of what's going on over there, and there's a lot of activity. There's a lot of investors that want to get out. There's a lot of investors that have already gotten out. You're seeing the same type of response in Taiwan locally. A lot of Taiwanese are trying to get out. And these are waves that just kind of follow the socio-political spaces around the world. It's not just China. You see these things happening in different countries around the world. And, your marketing efforts in those regions really have to take advantage of the timing of those kinds of issues as they arise. But I do think that you're going to see a lot of volatility in China. We're seeing it right now, and it'll continue.
Let's say thank you to Marisa and Sam